Want to grow your money fast but don't know where to start? I've got 4 simple investing rules for beginners in the USA. Number 1. Start small. Grow big. Even a little money invested now can grow a lot later. Number 2. Stocks, ETFs and bonds. Know your options to match your goals. Number 3. Don't make these mistakes. Avoid common pitfalls that slow down your growth. Number 4. Invest regularly. Win big. Consistency beats timing the market every time. Now, let's break each one down so you can start investing smartly today. First one. Start early and small. When it comes to investing, one of the most powerful strategies you can adopt is simply to start early, even if it's just a small amount. Many beginners make the mistake of waiting until they have enough money to invest, thinking they need thousands of dollars before they can begin. The truth is, time is often more valuable than the amount of money you start with. Starting early allows your investments to grow over time through the magic of compound interest, which Albert Einstein famously called the 8th wonder of the world. Compound interest is when your money not only earns returns, but those returns also earn returns over time. For example, imagine investing just $50 per month starting at age 25, versus waiting until age 35 to start. Even though the monthly amount is the same, the person who starts earlier can end up with significantly more money decades later simply because their investments have had more time to grow and compound. This is why starting small and starting now is more effective than waiting to invest a large sum later. Starting small also reduces risk and stress for beginners. Many new investors worry about losing money, and the fear of investing a large amount at once can be paralyzing. By investing small amounts, you learn the ropes of investing gradually while building confidence in your decisions. Over time, as your knowledge grows and your comfort level increases, you can gradually increase your contributions. The key is to build the habit of consistent investing rather than waiting for the perfect moment. Another advantage of starting small is that it allows you to test different investment options. You can experiment with a small portfolio of stocks, ETFs, or bonds to see which strategies work best for your financial goals and risk tolerance. This trial and error approach is much safer when your initial amounts are modest. It also helps you develop discipline and patience, 2 essential qualities for successful investing over the long term. It's also worth noting that modern technology has made starting small easier than ever. Many investment apps and platforms allow you to begin with as little as $5 or $10, and some even offer automated investing plans that deduct a small amount from your bank account each month. This automation makes it simple to turn investing into a habit without overthinking it. The key takeaway is that any amount invested consistently over time can grow into a substantial nest egg if you start early and remain disciplined. Finally, remember that starting early and small is not just about money, it's about mindset. Developing the habit of investing and prioritizing your financial future sets the foundation for long-term financial success. The earlier you start, the more time your money has to grow, and the more opportunities you'll have to adjust your strategy as life changes. Even if you can only start with a modest amount, taking that first step is crucial. Time in the market beats timing the market, and starting now, even small, puts you ahead of the majority of people who delay investing. In summary, the first step to building wealth is not waiting until you have a fortune, it's starting early, investing consistently, and letting time work in your favor. By beginning with small amounts today, you set yourself up for long-term financial growth and develop the habits that will help you succeed in investing for decades to come. Number 2. Know your options. One of the most important steps in investing is understanding the different types of investments available and how they can help you achieve your financial goals. Many beginners jump into investing without knowing the differences between stocks, bonds, ETFs, or other investment vehicles, which can lead to confusion, mistakes, or missed opportunities. Knowing your options allows you to choose investments that match your goals, risk tolerance, and time horizon, setting the stage for long-term financial success. Let's start with stocks. When you buy a stock, you're purchasing a small ownership stake in a company. Stocks have historically offered some of the highest potential returns compared to other investment types, but they also carry higher risk. The value of a stock can fluctuate significantly due to market conditions, company performance, or global events. However, over the long term, stocks tend to grow in value and provide opportunities for both capital gains and dividends. Investing in individual stocks allows you to target specific companies you believe will perform well, but it requires research, patience, and a tolerance for short-term volatility. Next, we have ETFs, or exchange-traded funds. ETFs are investment funds that hold a diversified portfolio of stocks, bonds, or other assets. They trade on stock exchanges just like individual stocks, which makes them easy to buy and sell. One of the biggest advantages of ETFs is diversification. By investing in a single ETF, you're spreading your money across many assets, which can reduce risk. For beginners, ETFs are often recommended because they allow you to invest in a broad market index or sector without needing to pick individual stocks. Examples include S&P 500 ETFs, which track the top 500 U.S. companies, giving you exposure to a large portion of the market in one investment. Bonds are another key investment option. When you buy a bond, you're essentially lending money to a government, municipality, or company in exchange for regular interest payments. Bonds are generally considered safer than stocks because they provide more predictable returns, but they also typically offer lower long-term growth. Including bonds in your portfolio can balance risk, especially if you want to preserve your capital while still earning income. Many investors use a mix of stocks and bonds to achieve a balanced portfolio suited to their goals. Beyond these, there are other options like mutual funds, real estate, or digital investment platforms, but the core principle remains the same: understanding your choices. Each investment type has its own risk and reward profile, and your strategy should align with your financial goals. For instance, if your goal is long-term growth for retirement, a stock-heavy or ETF-based portfolio might be appropriate. If you're saving for a shorter-term goal, such as a down payment on a house, lower-risk investments like bonds or high-yield savings accounts may be better. Another crucial aspect of knowing your options is understanding fees and costs. Some investments, like mutual funds or ETFs, may have management fees, while trading individual stocks might involve commissions. Even small fees can compound over time and eat into your returns, so being aware of these costs is essential. Finally, remember that knowing your options isn't just about picking the right investments, it's about building a strategy that works for you. Take the time to research, understand risk, and create a portfolio that fits your lifestyle, goals, and comfort level. Beginners don't need to invest in everything at once. Starting with a simple mix of ETFs and bonds, for example, can provide diversification and growth potential while keeping things manageable. In summary, knowing your options is the foundation of smart investing. By understanding the differences between stocks, ETFs, and bonds, as well as other investment vehicles, you can make informed decisions, balance risk, and build a portfolio that supports your financial goals. Investing isn't one size fits all, and the more you understand your choices, the better equipped you are to grow your money consistently and confidently. Number 3. Avoid common mistakes. Investing can be a powerful way to grow your wealth, but beginners often make mistakes that can slow progress or even lead to losses. Knowing what to avoid is just as important as knowing where to invest. By learning from common pitfalls, you can make smarter decisions, reduce stress, and increase your chances of long-term financial success. One of the most common mistakes is chasing quick profits. Many beginners see headlines about stocks skyrocketing, or hear stories of friends making fast money through a hot investment. The temptation to jump in and ride the wave is strong, but chasing short-term gains can be risky. Markets fluctuate, and what goes up quickly can also fall just as fast. Instead, successful investing focuses on long-term growth. Patience and consistency generally beat trying to time the market, which even experienced investors struggle to do reliably. Another frequent mistake is ignoring fees and expenses. Investments such as mutual funds, ETFs, or even brokerage accounts can carry fees that may seem small initially, but they can compound over time and significantly reduce your returns. Beginners often overlook these costs, focusing only on potential gains. Paying attention to expense ratios, trading commissions, and management fees helps you maximize your investment's growth and avoid letting unnecessary costs eat into your profits. Lack of diversification is another key error. Putting all your money into a single stock, sector, or asset type may seem exciting, especially if it performs well initially. However, lack of diversification increases risk. If that one investment fails, you could lose a significant portion of your portfolio. Diversifying across stocks, ETFs, bonds, and other assets helps balance risk and ensures that one bad investment doesn't derail your entire strategy. A well-diversified portfolio smooths out volatility and increases the likelihood of consistent growth over time. Many beginners also make the mistake of reacting emotionally to market fluctuations. Seeing the value of your investments drop can trigger fear, leading to impulsive decisions like selling at a loss. On the other hand, greed can lead to buying too much when prices are high. Emotional investing often leads to poor timing and lost opportunities. A disciplined, long-term strategy helps you stay calm during market swings and prevents short-term emotions from undermining your financial goals. Another common pitfall is neglecting to educate yourself. Investing without understanding what you're buying is like sailing without a map. You might get lucky, but more often you'll encounter unnecessary risks. Taking time to learn about stocks, ETFs, bonds, risk management, and financial planning helps you make informed decisions and avoid costly mistakes. Start small, read reputable sources, and consider using educational tools or beginner-friendly investment apps to build your knowledge gradually. Finally, some beginners fail to review and adjust their strategy. Life circumstances, goals, and market conditions change over time. Sticking rigidly to a plan that no longer fits your situation can prevent you from optimizing your returns. Periodically reviewing your portfolio, rebalancing assets, and updating your strategy ensures that your investments continue to align with your long-term objectives. In summary, avoiding common mistakes is essential for beginner investors. Don't chase quick profits, pay attention to fees, diversify your portfolio, manage emotions, educate yourself, and regularly review your strategy. By steering clear of these pitfalls, you can protect your investments, grow your wealth more consistently, and build the confidence needed to succeed in the world of investing. Remember, successful investing is not about being perfect, it's about making smart, informed choices and learning from experience over time. Now the last one. Consistency is the key. When it comes to investing and building long-term wealth, one of the most powerful principles is consistency. Many beginners focus too much on finding the perfect investment, or timing the market, but the real driver of long-term growth is investing regularly over time. Consistency allows you to take advantage of compound growth, smooth out market fluctuations, and develop strong financial habits that last a lifetime. Consistency starts with regular contributions. Even modest amounts invested on a weekly, bi-weekly, or monthly basis can grow significantly over time. For example, putting aside $100 every month may not seem like much initially, but over 20 or 30 years, those contributions, combined with investment growth, can turn into a substantial sum. The key is not how much you start with, but that you make investing a habit and priority. Automating contributions through apps or recurring transfers from your bank account makes it easy to stay consistent without having to think about it every month. Another advantage of consistency is dollar cost averaging. This is a strategy where you invest a fixed amount regularly, regardless of whether the market is up or down. By doing so, you buy more shares when prices are low and fewer shares when prices are high. Over time, this approach can reduce the impact of short-term market volatility and lower the average cost of your investments. It's a simple yet powerful way for beginners to invest without trying to predict market highs and lows, which is nearly impossible to do reliably. Consistency also strengthens your financial discipline and mindset. Regularly setting aside money to invest encourages long-term thinking and prioritizes your future financial security. It reduces the temptation to spend impulsively or react emotionally to market swings. By staying consistent, you build confidence in your investing strategy and develop habits that will benefit you for years to come. Many beginners make the mistake of stopping or pausing their investments when the market dips or when life expenses arise. While emergencies happen, It's important to treat investing like a non-negotiable financial habit, just like paying bills or saving for necessities. Missing months or years of contributions can significantly impact your long-term growth, because the earlier and more consistently you. Remember, investing isn't about getting rich overnight, it's about making smart decisions, building good habits, and letting time work in your favor. The earlier you start, the more confident and prepared you'll be for life's financial opportunities. Even small, steady steps can lead to big results over the years. So take action today. Open that investment account, set up a regular contribution, and commit to learning as you go. Every dollar you invest consistently brings you closer to financial freedom. The key is to start now, stay consistent, and trust the process. Your future self will thank you.